Module 10 to 1 P/E ratio and cyclical stocks. Analyzing the P/E ratio of cyclical stocks requires some specific considerations due to the nature of these companies and their earnings patterns. Here are key factors to keep in mind when evaluating the P/E ratio of cyclical stocks. Understand the business cycle. Cyclical stocks are typically tied to the business cycle, meaning their performance is influenced by economic expansions and contractions. These companies tend to experience fluctuating earnings based on the overall economic conditions. It's essential to understand where the company is in the business cycle and how it impacts its earnings. During economic downturns, earnings may be depressed, resulting in higher P/E ratios. Conversely, during economic upswings, earnings may be robust, leading to lower P/E ratios. Evaluate earnings volatility. Cyclical stocks often have higher earnings volatility compared to non-cyclical stocks. This volatility can impact the P/E ratio significantly. It's important to assess the historical earnings patterns of the company and consider the factors that influence its earnings, such as commodity prices, interest rates, or consumer spending trends. A company with more stable and predictable earnings may warrant a higher P/E ratio, while one with more volatile earnings may have a lower P/E ratio. Consider earnings normalization, given the cyclical nature of these stocks. It can be useful to look beyond current earnings and consider the long-term earnings potential. Earnings normalization involves adjusting the earnings figures to reflect a more sustainable level that captures the average earnings power of the company over a full business cycle. This can provide a more accurate representation of the company's valuation and assist in comparing it to non-cyclical peers. Look for leading indicators. Analyzing leading indicators can help anticipate the future performance of cyclical stocks. Leading indicators are economic or industry metrics that tend to change before the broader economy does. For example, in the construction industry, building permits or housing starts can serve as leading indicators. By monitoring these indicators, you can gain insights into the potential future earnings trajectory of the company and its industry. A low P/E ratio during a period of economic recovery, when leading indicators are positive, may indicate a potential value opportunity. Consider debt levels and financial strength. Cyclical companies can be more vulnerable to economic downturns, and their financial strength becomes crucial. Evaluate the company's debt levels, liquidity position, and ability to withstand a downturn. A high debt burden combined with a high P/E ratio may indicate higher financial risk. Conversely, a company with a strong balance sheet and lower debt levels may be better positioned to weather economic fluctuations and potentially offer more stability and resilience. Analyze management's track record. Assess the company's management team and their ability to navigate through various economic cycles. Look for management teams that have demonstrated effective capital allocation, cost management, and adaptability to changing market conditions. A strong track record of successfully managing through economic cycles can provide more confidence in the company's ability to generate sustainable earnings and potentially impact the P/E ratio. It's important to note that cyclical stocks require careful analysis and a forward-looking perspective. Understanding the dynamics of the industry, the specific drivers of the company's earnings, and the broader economic conditions is crucial. Utilize a combination of financial analysis, industry research, and macroeconomic insights to assess the P/E ratio of cyclical stocks and make informed investment decisions. Economic cycles and industry dynamics have a significant impact on the P/E ratio of cyclical companies. Here's a closer look at how these factors influence the P/E ratio. Economic cycles. Cyclical companies are highly sensitive to changes in the business cycle. Economic cycles consist of periods of expansion and contraction, and cyclical companies' earnings tend to fluctuate accordingly. During economic downturns or recessions, cyclical companies may experience lower demand, reduced sales, and declining profitability, resulting in lower earnings. As a result, their P/E ratios may appear higher due to depressed earnings. Conversely, during economic upswings or expansions, cyclical companies tend to experience higher demand, increased sales, and improved profitability, leading to higher earnings. This can result in lower P/E ratios as earnings rise. Therefore, understanding the stage of the economic cycle is crucial for interpreting the P/E ratio of cyclical companies. Industry dynamics. Industry dynamics play a significant role in determining the P/E ratio of cyclical companies. Each industry has its own unique characteristics, supply-demand dynamics, and sensitivity to economic cycles. Industries such as construction, manufacturing, automotive, and travel are typically considered cyclical. Factors such as changes in commodity prices, interest rates, consumer spending, and government policies can impact these industries and influence the earnings of cyclical companies within them. During periods of industry expansion and strong demand, cyclical companies may experience higher earnings growth, leading to lower P/E ratios. Conversely, during industry downturns or weak demand, cyclical companies may face earnings contractions, resulting in higher P/E ratios. Investor sentiment. Investor sentiment also plays a role in the P/E ratio of cyclical companies. During economic downturns or periods of uncertainty, investors may be more cautious and assign lower valuations to cyclical companies due to concerns about their earnings sustainability. This can result in higher P/E ratios as earnings decline. Conversely, during economic recoveries or periods of optimism, investors may have higher growth expectations for cyclical companies, leading to lower P/E ratios as earnings rise. Investor sentiment can be influenced by broader market conditions, macroeconomic indicators, industry-specific factors, and company-specific news. Forward-looking expectations. The P/E ratio of cyclical companies is influenced by forward-looking expectations of future earnings. Investors assess the potential for earnings growth or contraction based on the outlook for the industry and the economy. During economic expansions, when the outlook is positive, investors may have higher growth expectations for cyclical companies, leading to lower P/E ratios. Conversely, during economic contractions or industry downturns, when the outlook is uncertain, investors may have lower growth expectations, resulting in higher P/E ratios. It's important to note that the impact of economic cycles and industry dynamics on the P/E ratio of cyclical companies can vary based on the specific company and industry. Some cyclical companies may be more resilient or have unique characteristics that make them less susceptible to economic cycles, while others may be highly dependent on economic conditions. Therefore, conducting thorough research and analysis of the company, its industry, and the prevailing economic conditions is essential to understand the implications of economic cycles and industry dynamics on the P/E ratio of cyclical companies.